Ladies and gentlemen, good day and welcome to the Q4 and FY21 earnings conference call of Neogen Chemicals Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and welcome to Neogen Chemicals earnings conference call for analysts and investors. The call has been hosted to discuss the fourth quarter and full year financial performance and share operating highlights of the company. Joining us on the call today are senior members of the management team, including Dr. Harin Kanani, Managing Director, Mr. Anurag Surana, Director, Mr. Ketan Vyas, Chief Financial Officer. We will commence the call with opening thoughts from the management team, post which we shall open the forum for question and answer session, where the management will be glad to respond to any queries that you may have. At this point, I would like to add that some statements made or discussed on the conference call today may be forward-looking statements. The actual results may vary from these forward-looking statements, and a detailed disclaimer in this regard is available in Neogen Chemicals Q4 and FY21 earnings presentation, which has been shared earlier. I would now like to invite Dr. Harin Kanani to commence by sharing his thoughts on the strategic progress made by the company. Thank you, and over to you, sir.
Hi, Nishit. Thank you so much. Good evening, everyone, and welcome to Neogen Chemicals Q4 and FY21 earnings conference call. These are tough times for all of us, and I hope you and your close ones are safe and in good health. Our earning presentation has been shared earlier, and I hope you have analyzed the key numbers. I will begin by sharing We have displayed resilience and reported encouraging performance during the quarter and full year under review. The growth trajectory in FY21 was maintained with 10% revenue growth achieved in spite of capacity constraints as well as other restrictions imposed due to COVID-19 pandemic during the year. Our margins expanded to 19.1% and profit increased by 9% in FY21. Positive demand across key end-user industries ensured optimum utilization at all our plants with supply chain efficiency. Revenue growth of 10% in FY21 was led by similar growth in organic chemicals and 11% growth in inorganic chemicals after we expanded this facility at Dahej SEZ last year. As you may be aware, lithium is a key raw material for the inorganic chemical segment, and we witnessed high volatility in the price of lithium in FY21, mainly on the downward side. So to that extent, our inorganic chemical revenues were lower. We have estimated this impact at around rupees 19 crore during FY21, meaning our organic revenues during this period would have been higher at around 82 crores versus rupees 63 crore segment revenue we have reported had lithium prices remained constant. Now let me update you on our progress of organic chemicals at Dahej SEZ. I am glad to state that the expansion plans have progressed well despite widespread disruptions related to COVID-19 pandemic. We have installed all equipment including reactors and have commenced manufacturing of initial commercial batches. Aspects like product quality assurance and customer validation procedures are in progress, after which full commercial production will begin. This is a very proud moment for us because Neogen has for the first time built a plant from zero to final commissioning stage with the most advanced safety features and engineering standards. This is state-of-the-art manufacturing infrastructure of international standards will be a point of inflection for Neogen as this plant has been built as per the standards expected by innovators and global MNCs and will enable us to deliver greater value addition through multi-stage processes and complex chemistries. I would like to express thanks to our team at Dahej for their dedication and focused contribution to the implementation of this project in the most difficult times. With the new facility now operationalized, let me reiterate that our FY22 revenue guidance of rupees 450 crore remains unchanged and it will be our endeavor to achieve it. I will conclude by adding that Neogen remains well poised to benefit from the structural shift in chemical supply chain. Our market leadership position, cost-efficient production capabilities, and relentless focus on innovation will help us to capitalize on this opportunity. Our endeavor is to work diligently and drive long-term value for all stakeholders through focused execution on our planned initiatives. With that, I conclude my opening comments and would request our CFO, Mr. Ketan Vyas, to continue the discussion by sharing his views on our financial performance. Ketan, over to you.
Thank you, Dr. Hari, and a very good evening to everyone present on this call. I will discuss the financial performance of the company for the fourth quarter and full year ended 31st March 2021. In Q4 FY21, our revenues increased by 13% year-on-year to rupees 93 crore. EBITDA improved by 17% to rupees 19 crore, translating to EBITDA margins of 20%, an expansion of 80 basis points year-on-year. Profit after tax stood at rupees 9 crore, higher by 27% year-on-year. In Q4 FY21, our domestic and exports mix stood at 53% and 47% respectively. For FY21, we witnessed 10% improvement in revenues to rupees 336 crore, driven by robust demand for key products. This was achieved despite nationwide shutdown impact for first 2 months of the year and localized restrictions imposed due to second wave of COVID-19. EBITDA enhanced by 11% to rupees 64 crore, led by realization gains as well as higher operating leverage. Positive EBITDA performance was delivered even though additional costs were incurred this year on account of COVID-19 related safety protocols. PAT was higher by 9% to rupees 31 crore as a result of better operating efficiency. And that concludes my opening remarks, and I would now request the moderator to open the session for questions from participants. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kaushal Shah from Dhanki Securities. Please go ahead.
Thank you very much, sir, for the opportunity and congrats for the good set of numbers. Sir, I had one question on the additional capex of around 55 crores that we had planned in Dahej. So if you can throw some more light on that and when that is likely to be commissioned, that was one. The second was if you can maybe share some more color on any new customer additions. If I recollect our earlier interaction on the calls, I think you had signed a few long-term customers, I think in Q2 and Q3. So maybe some color on that. Have you started supplying to these new customers, etc.? That's it.
Okay. Thank you for your question. Yes, so we have completed the initial 75 crore capex, as well as we have continued, and we've also started the second 55 crore also in parallel, because it was more efficient for us to get some of the work done together. So the investment continues on the 55 crore as well, and it will be done over a period of this year. So majority of this, so the additional reactors which we are installing will keep coming gradually between Q3 and Q4 so basically the second half of the year, and we expect to complete the complete investment by end of the current financial year. In reference to the business with the two multi-year contract customers, with both these multi-year contract customers, we have received relevant POs and the POs for the year, and the business with both the customers have initiated. And with other customers which we mentioned we were in discussion, the discussions are progressing stage-wise, but so far there is nothing concrete from a long-term point of view for us to add there.
Great. That's it for now, sir. I'll join back in the queue. Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Rohit Nagraj from Sunidhi Securities. Please go ahead.
Yeah, thanks for the opportunity and congrats on good set of numbers for the quarter and during the pandemic time. So the first question is in terms of the availability of our raw material and as well as from the exports perspective. So we have seen that there have been a lot of disruptions in logistics as well as supply chain. So have we faced anything of this in the last couple of months from both the sides, sourcing as well as from exports? Thank you.
Hi Rohit, thank you for your question. Yes, logistics have been a bit of a challenge, and I think over a period of time we've seen it slightly improve. So what it was in March and April, it is relatively slightly more better now. But fortunately, we had planned sufficient raw material inventory because if you remember in last year also we said we had increased our raw material, especially imported raw material supply. As well as when it comes to main key raw materials, bromine also we had kept sufficient inventories. So our operations were not impacted because of this. To some extent, yes, your exports were delayed in getting shipment or reaching to the customer, or some material was also coming in a bit late. And to that extent, your realization of funds, etc. may get delayed, but nothing which impacted overall significantly in our revenue or P&L.
Right. That's good to know. So the second question is in terms of the CSM opportunity. So how are we looking at it from a medium-term perspective? So in which ways we currently have, I think, about 10% of our revenues coming in from CSM, and that should grow in the next 3 to 5 years. So over a 3 to 5 year period of time, how this opportunity could be capitalized, and how are we placed in terms of taking on that opportunity from the management bandwidth perspective, probably the expansion perspective, R&D? If you could just throw some light on this. Thank you.
So I think, to first deal with the quantitative numbers part. So what we had said is that, currently roughly around 30% of our business comes from advanced intermediate, and CSM is a part of this 30%. About 10% is currently close to that is around CSM business. And what we had mentioned is that as our revenue goes and as we have the full utilization of, the total overall capex we are doing in Dahej, which will give us a capability of around 650 to 670 crore. So while targeting to reach this 650, 670 crore, we are targeting to increase the share of advanced intermediates to about 40% and CSM being 20% of that. So this is the initial target that we have set, for ourselves. Now, how are we going to achieve that? So in our R&D, as I've also shared earlier, almost 60% of the R&D capacity is being driven by the CSM business. And also over last 3 years, while our revenues have increased, our R&D expense has increased even faster. So the percentage of expense as R&D in last 3 years has gone up from around 0.5% to close to around 0.9% this year, the year which got completed, and we are expecting to cross even 1%. So our revenue spend in R&D is also increasing. We are also planning some more additional capex to support the projects that we have. So I think we've also added, one additional VP R&D. So we already had one senior R&D, and we've added one more VP R&D, below which we have a team of R&D scientists which we keep expanding. We've also added a VP dedicated business development for just CSM business. So I think with this addition, with our focus, and again with the interest that we've had from the customers, we are in a good shape to expand our R&D activity and get higher share in CSM. I think our Dahej site getting commissioned will also help us in this regard, because as I mentioned in the opening remarks, this is the first time we have been able to make a plant from scratch. So we've got a lot of inputs from our senior management team, Mr. Surana, and other team members who are now part of Neogen, who have also worked in larger organizations of what standards are expected by global MNCs. And we think we have done a very good job of meeting this. So once the hedge starts, we should be able to even approach now more customers, and with having some capacity available, we should be able to approach more customers that look, we have capacity, it is as per your requirements. We also have a good R&D setup now, so we can capture this, trying to achieve 20% of, let's say, 650 crore over next 2 to 3 years is what we are planning to do. And further down the line, now we have also environment clearance at Dahej. The site is active, so now it has a basic infrastructure, the buildings, etc. are made. So if we have to do capex, so every year we can keep evaluating what projects are coming, what is the underlying business commitments, and based on that, if we want to do even future capex, hopefully we should be able to turn it around also faster. So I think this will all allow us to capture the CSM opportunity in both agro as well as pharma space over next 3 to 5 years.
Yeah, got it, sir. Thanks a lot and best of luck. I'll come back in the queue for follow-up.
Thank you, Rohit.
Thank you. The next question is from the line of Saurabh from AMSEC. Please go ahead.
Thank you for the opportunity. So we are seeing the improvement in working capital in this year. So just wanted to get more color, like, is it at this level we can sustain or we can further improve with the capacity coming in?
Yes. So I think, last year, as we had mentioned, was a bit abnormal because of COVID-related last-minute situation. So we have been able to improve our working capital cycle in the year which just got over. Yes, our target is especially beyond FY23 and FY24. So in FY22, we would like to at least maintain this level, improve it to some extent. In between the year, you might see some fluctuation because the Dahej plant is coming up. We are building up inventory. But at least by end of the year, once operations are smoothened out, everything is normalized, we are at the current level or still slight improvement. And then going FY23-24 to further improve upon working capital levels as compared to current. Because we realize that, when we want to grow very quickly, this is one area where improvements will help us conserve our cash and also give better returns on equity and ROCs, etc.
So this improvement will largely come from inventory side or still there is scope on creditor side?
I would say inventory side and to some extent on debtor side.
Right.
So as our exports also increase, we will also try to see to have terms where debtors can also be improved. I think for creditors, we already had taken a view and we have talked to our major long-term suppliers. So people who are supplying us bromine or some of them who are supplying lithium or some other raw material of relatively higher value. These people are now, with Neogen's profile improving. Last year, we also got upgraded by CRISIL. So all these help them to discount, get Neogen's bill discounted. So therefore, we could ask for more longer, the credit terms with them, because we recognize that this will help us. I mean, this is something which is needed when our business is growing so fast. So therefore, that is what allowed us to improve the creditor days. And more or less, I think, we are roughly at around 65, 70 days or so. And this will also keep improving. We also got, so everything that we do is also part of the team. So as I mentioned earlier, as we got a VP for R&D and business development, we also had a GM procurement who came to our team who has, worked in large company. So we are now buying less from traders. We are buying more from, directly consumers. And we are also trying to negotiate better terms with, allowing them to get some discounting arrangement based on Neogen's credit rating. So I think that has given the creditor improvement. Our future improvement should largely come from debtor side and, inventory side. And, if we get something in creditor, we'll not complain. I mean, we would like to, improve those to use our, market presence in buying in some of the molecules.
Okay. And so the second question was on the plant. So by next quarter it will be commercially operational?
Yes. So already we are making products which, for which we already received POs from our customer, and whatever we are currently producing will ultimately start going to customers. So yes, only what happens is when a new plant starts, we have to sometimes. So many of them are transfer of technology from my Mahape plant and my Karakadi plant. So we have to make sure that the technology got transferred. We have to demonstrate to our customer that the testing results here and there are the same, the systems are the same, the quality is the same, and get some of their approvals on the line once the production has commenced. So that's the reason why it will start adding to the revenue from next quarter, and more or less, by Q3 or Q4, we expect that it will be much higher. We'll be focusing then on the efficiency part, the utilization levels and how efficient are the operations to stabilize the new site. So as we go through the year, you will see more and more improvement in the revenue. So as we go from Q2 to Q3 to Q4, which is contributed from the Dahej side.
Okay. So one more on the raw material side. So are we seeing any kind of raw material price pressure maybe in this quarter, maybe in the next quarter? That like with we having a long-term contract, maybe we are not able to pass on immediate basis and with a lag.
So you mentioned raw material pressure in what? Sorry, the voice got bit.
So any margin pressure in terms of higher raw material prices?
Right. So, not specifically with regards to raw material. We are not expecting a margin pressure because of that.
Okay. And so the last one on what was the utilization for the inorganic plant?
It was somewhere in the range of around 60 to 70%.
Okay. Thank you.
Thank you. The next question is from the line of Swarnabh Mukherjee from Edelweiss. Please go ahead.
Thank you. Hi, Harin. Good evening. Thanks for the opportunity and hope all good at your end.
Yes, Swarnabh. Thank you. I hope everything good at your end too.
Yeah, so far so good, sir. So 2-3 questions from my side, and apologies if it has been asked because I missed the first few minutes of the call. So wanted your thoughts on the gross margin development this quarter. Is it a factor of a better product mix? Because I think overall raw material prices have increased for your base raw materials as well, but you do have a annual contract kind of a thing, if my understanding is correct. So what led to this better margin profile, if you could highlight on that?
So Swarnabh, it's 2 factors. One is just a little bit on the product mix side, where you can see the gross margin. So where we were now doing in this quarter more of the long process value-added molecules. So we had seen little bit raw material cost was lower, and the manufacturing cost, which is captured in other costs, is slightly on a higher side. So this is a bit of the nature that slightly lesser raw material margins, gross margins are improved, but the manufacturing costs are a little bit higher. And the second was lithium, where the lithium prices had kind of reduced. Again, that trend throughout last year was there, and it was most pronounced in Q4 because the Q4 of India was Q4 of the material that we received in Q4 of India was from Q4 of the calendar month of the world. But in 2021, again, now the lithium prices have started, after hitting the bottom, they started again and increasing quite fast. So last year we also suffered because of lower lithium prices. Our selling prices were also lower, and almost we had a revenue differential of around 18-19 crores. So this year, again, it has not yet gone to that level, but again, the trend has started reversing. So I think this was just one quarter. Overall, if I look at overall whole as a year, we were more or less in the line which is 58 to 62% RMC or 42 to 38 percent gross margin level. So okay, more on the higher side, so 42%. So let's see how this year goes and how the product mix develops, and we see whether this remains a constant trend or it is just maybe for couple of quarters depending on product mix.
Okay, sir. So, are we able to pass on the prices even if it goes up? So, would say, for example, to rephrase, would we be able to maintain, say, a consistent EBITDA per ton kind of a margin, even at an absolute level?
Yeah. So, this lithium price increase is a bit tricky, and generally what we've been trying to do is that whenever we are booking POs with our customer, or when I am booking new lithium from my supplier, we are kind of ensuring that we don't have too much of uncommitted inventory, right? In a sense, you can't take a very large order for which you don't have a supply, versus you can't put a very large order of lithium when you don't have a customer commitment. So we are basically controlling that. Now, whether it gets, so again, the bare minimum that we get is the absolute margins in lithium are always controlled. So we never go down on that. But, because sometimes, if we, depending on the supply demand situation, competitor situation, we can also get away with maintaining our EBITDA. But overall, overall lithium is also only 15-20% of our business. And that is where you are seeing this kind of a trend. So overall, 0.5 to 1% range, can vary overall because of the product mix. And that's why, I always give, 18 plus minus 1%. So I take that 2% kind of a cushion, partly because of, the product mix changes or such kind of fluctuation.
Okay. So, in terms of the new set of businesses that is getting developed or seeded, just wanted to have an understanding. So, for example, if you could give either some quantitative or a qualitative commentary on how your new products set is shaping up, say, for example, like new molecules that are going to be commercialized in FY22, how many you have commercialized in 21, and what are you seeing from your customer side, any impact of the China Plus One thing, if it is playing out? Because last call, I think you mentioned on this, and just wanted to understand anything additional that is coming up with this.
No, so Swarnabh, I think, not something much to add. I mean, so the trend is still continuing. Customers are also watchful. They were concerned with, the COVID situation, especially the second wave and the negative publicity which it had all over the world. But at the same time, we were in constant touch with them. We have kept our operations on to the best of our abilities, and our customers also have appreciated that. And I think the development work also is on track. So there has been no negative, impact because of, COVID or any other reasons on the development plans that we had. Also, we keep getting more inquiries and more projects from customers. So, every quarter we are getting new customers inquiries, new projects, and we've now, as I mentioned, we have now a VP in business development. So with his help, we've also now formalized this entire process of how all new products inquiries will be, screened, and how they will be monitored, and kind of a stage gate procedures for that. So those things are progressing quite well. And, we remain, so our current target is, to make sure that what we have committed, so the existing installed capacity is 650 to 675 crore. So ensure that in next 2 or 3 years, do we have enough customer approvals and projects to kind of fill this capacity fully. And once we do that, then comes the next phase that, okay, what is it that we want to go do that. So currently, based on the project pipeline, we remain confident that this goal that we had set ourselves to try to utilize this capacity fully by FY24 remains on track. There is no negative impact, and we will keep monitoring every year, what the demand looks like and whatever capacity looks like, and keep making decisions based on that.
Okay. So, given that, the picture looks even more rosier than maybe a year back or a couple of years back when we had started interacting, is this 450 crores guidance that you had given, is it looking something to be a little bit now more on the conservative side? And should we expect that going ahead we may be able to exceed that?
You mean going ahead, meaning this year, right? So
this year,
target, yeah. So in this year, there are, the plant is also starting now. Like they've just started operation in the month of May, and it's stabilizing. So because it's the first year, I would, and also first year there are a lot of customers, approvals, etc. are involved. So that's the reason I would not like to comment to go beyond that. And also we don't know how this COVID plays. Frankly speaking, if we were to look at last year, yes, last year in the first 1.5 months, we had a very strong challenge because the lockdown was very severe. There was a lot of confusion. So, plants were either closed or partially closed. But, we also had the benefit that we had an overhang from the previous year. So that kind of more or less made up for it, correct? But in current year, in the second wave, but if I were to look after that, we were kind of running very smoothly, and there was not, like, beyond May or June, there was not very significant impact because of COVID. But in the second wave, many more staff were kind of affected, and more people were affected, more had to get hospitalized, and even they took time to recover. Also, what used to happen, the bigger challenge for us, which we keep facing, is the engineering industry, because as compared to chemical, in engineering industry, we see even more people working very closely and more manual operations. So they get more affected. And many a times we have a case where, our some critical, so especially when we are starting the hedge, these new equipments, we have everything ready. When we started, we want the team to be present to kind of guide us or for troubleshooting or things like that. But, they say, oh, all my field engineers are affected, we can't come. So those challenges are also still there. So I think, maintaining 450 in spite of whatever has happened, the challenges also that we faced in April and May, that itself is a target. So I would not want to kind of enhance that for the current year. And yes, whatever we said, things which are improving, what we are seeing is bound to help us, in the coming years. And that also remains, we already committed so that, complete the capex so that we have a capacity of around 650, 675. So let's see FY23-24 how it plays out.
Sure, that's very helpful. If I may squeeze in two quick bookkeeping questions. So your payable days, your payables have actually gone up a bit in the half year. Now it has slightly come down, but it is still high compared to FY20. Is this outcome of, better credit terms that you have gotten from your suppliers? Or is there anything else to do?
No. Yeah, so I answered that earlier. So it's mostly because of the better credit terms that we've gotten, from our suppliers. And with Neogen credit rating, etc., improving, my long-term creditors are able to, discount Neogen bills. So because of better visibility on Neogen and things like that. So they can give us better credit terms over a period of time. And as I mentioned, we also have a new person in our procurement team who has, handled purchase of 1,000 crore plus kind of a company. So he also knows how to, get better terms and manage cash flows and things like that.
Sure. And last question, sir, on the debt side, do we expect any further increase on debt levels from FY21 end?
Yes, so there's still some capex which is pending, and also as our business will increase, so debt will increase. Again, Ketan, let me maybe just, since we are completing, Ketan is a better person to answer this, but our expectation is in the range of around 250 to 275 could be the debt levels by the end of the year. We'll try to do better. It will depend on exact working capital level improvements, but this is what we are looking at the end of the current year.
Okay. Thank you so much. That was very helpful, and all the best for FY22. Thank you.
Thank you, Swarnab. Yeah.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Hi, Harin. Given the fact that we are in a kind of a niche branch of chemistry and a specialized one, and if you look at over 3 years, won't you say that our growth is somewhat below our strengths and ability to deliver? Even our margins don't fully reflect the kind of specialty work that we do. Because if you see much bigger chemistry firms are growing at a rate faster, and the margins are also at a level which reflect that at a far superior numbers.
Bharat, thank you for the question. First of all, especially if we were to look at last 3 years, and I would request you to look 1 more year behind. So when we bought Karakhadi unit, in FY16, so we were at the end of almost close to end of Q3 of FY16. So in FY17, we had only 1 quarter, we had around 110 crores. So from 110 crore in FY17 till, let's say, FY20, we went from 110 to almost 300 odd crores. So that was, in my opinion, at least relatively quite good growth rate compared to our scale and compared to the capacity which was available. Last year, yes, I mean, to some extent, ideally, if this capacity would have come earlier, we could have even had a better growth rate. And yes, I mean, there was COVID issue. There was some growth which we missed because of lithium prices also being lower. But overall, yes, the growth rate could have been better. So I think for me, the last year was similar to FY17, where we increased only from 100 to 110. But we acquired the Karakhadi site. We kind of created a framework which allowed us to grow well for next year. So I feel this last year was like that. And again, this sets the tone for going forward, for us to go from around 336 crore we have done to, let's say, 675 crore by FY24. So this is what we are currently targeting. And again, during this year, we also said that we will carefully keep looking at the opportunities in front of us, choosing the right opportunities very carefully. And whenever we feel that, there is a need, especially, I think FY22 and 23, we have enough capacity. But in FY24, for FY24, we can see whether 650 is still the number, or as you said, because of our niche chemistry, because of interest, we can do better than 650. And then if necessary, we can plan some capex in the second half of FY23 to ensure we have some additional headroom to grow in FY24. This is one side. The second thing about, improving the margins, I mean, I take your point. And, this also what we have seen is that many of these companies also in the legacy business don't earn so much. And then when they go when they go to more complex molecules with innovators, that is when slowly the margins improve. So we've just started that journey. That CSM business, which we do more with innovator, is still only 10%. And still 50% come from, one stage bromine derivative, or another 17% come from inorganic chemistry. So what we see is a combination of that. So we would hope that as we go to, let's say 650, 675 by FY24, and if we are able to convert this, increase in the advanced intermediates and the CSM business with innovators, then our margins also should improve. But this is a target in front of us. I really need to first do it, and then I can claim I have achieved it. So I hope, Bharat, I answered your question.
Yeah, sure. I appreciate that, but let's say we do 650 in 3 years from now, from the 335 crore that we've done in FY21. That still essentially will mean about doubling, so about 24% compounded growth. And if our margins are unlikely to get beyond, get into the band of 20s rather than 18 or 17 or 19, that would still mean more or less similar kind of a growth in profitability. And if you look at much larger firms in the chemistry side, they've been able to grow profits at a rate faster. Similar, or let's say smaller size firms, not as small as yours, but many of them are growing at a rate much faster with far higher margins. So, question is whether there is a limitation on the branch of chemistry and what we are doing, or we need to be more aspirational.
So I think we need to be more aspirational, keeping in mind, the risks and our, ability to manage growth. So as I mentioned, currently this is the number we have for FY24. And, we will, as I've said, at the end of every financial year or kind of basically between December to March, we will keep looking and we can say, can we be more aspirational as opposed to, taking undue risk? So that will take a decision whether we can grow. I mean, this is the visibility that we have now. And every year, if suppose, for example, if we take a decision to have more capex in FY23, I mean, it will increase the ability for me to do a higher revenue in FY24. This is what I can do now, which from my point of view is already quite ambitious. I mean, if we are growing 24-25% year on year for the next 3 years, with a chance of increasing it if things turn out well, that's what we want to currently start with. And then we will see more we can do every year if we have a clear business visibility. And again, on the margin side, I take your point. I mean, we need to do a better job, whether that is from better efficiency or through the scale of operation will allow us to do that. In my opinion, mostly it is innovation. I mean, we have to work, especially in the line of products we are, that now we have started doing complex molecules, and now in complex molecules, when we do majority innovation, that's when we'll be able to deliver better margin.
Sure. One last thing. While compared to the past, leaping into 650 odd crore bracket certainly is a jump. But do you see any possibility that this 650 itself, let's say we end up achieving say 575 or 600, that still will mean materially kind of a reduced performance? So do you see a risk to that, or do you think that is reasonably should be aimed at and is possible to get?
So we are relatively quite confident that, this is something which we can achieve. This was the basis of our investment, because now some of the additional revenue that we are targeting of around 650 crore, the additional revenue that we are targeting, some of it has already come back where we have visibility. And I personally feel, as I mentioned earlier also, we always keep up option B, option C, etc., to make sure that, if this doesn't work out, then we have this customer or this product revenue. So while, margins may depend upon, more profitable business works or more contract works, but achieving 650, what we have, 650, 675 in that range by FY24, to me, feels reasonably confident. But again, the only caveat here is, how bad COVID becomes, how whether there's too much of a global protectionism or make at home kind of a concept. So those are things I don't know, which may make it more difficult. But from our side, so that's why we've not kind of given a formal guidance for 23 and 24. But we say we have a capacity for doing this, and we feel that we should be able to achieve peak utilization by that time.
Sure. Thank you all.
Thank you, Bharat.
Thank you. The next question is from the line of Pritesh Chadha from Lucky Investment Managers. Please go ahead.
Yes, sir. Just one clarification from your commentary. What we are executing in terms of CapEx is the 55 crore CapEx at Dahej for putting up the 125,000 kiloliter capacity, right? Or are we doing one more round of CapEx of 55 crore, which is supposed to, for which the reactors will start coming from Q3 and Q4?
Yeah. So, yes. So we had, if you look at our second quarter earnings call, we had said that in addition to the 75 crore, we are planning an additional 55 crore, which will give us a overall capacity, of, let's say, it's about 650, 675 crore by FY24, as against the previous investment was going to give us a visibility of around 500 crores. So this additional reactors, as I mentioned, so will also start coming partly in Q3 and Q4.
Okay, so when you mention 675 crores as your peak revenue, you are considering both the recently announced 55 crore capex, which you said about in the quarter two, and the 70 crore which you had announced earlier, which included, let's say, 15 crore for inorganic and some 45, 50 crores for organic, right?
No, it was 15 crore inorganic, then 75 crore organic, and then this 55. So I think if you just, there's a note in Q2 conference call earnings presentation that will give you the clarity.
Okay. And so just 675 includes all, right? Just
yes. Okay. All the capex which has been announced together is good enough for us to reach around 675.
So when you achieve this revenue, what will be the change in your revenue mix from the current mix of bromine derivatives, advanced intermediates, and lithium derivative? What would be the mix change?
So what we have targeted is that we achieve about 40% bromine derivative as against around 50-55% now. Then we said that the advanced intermediate will expand again from 30 to 40%. And then the lithium will be roughly around 20%. So instead of 50, 30, 20, it will be 40, 40, 20. And within that 30% currently, 20% is advanced intermediate and 10% is CSM. So we said we are trying to do 20% advanced intermediates and 20% CSM as part of the 40%. So that's something which we have discussed over the earlier call.
And what is the incremental gross margin in the advanced intermediates?
So again, at EBITDA level, they are similar. Now within advanced intermediates, some of them use higher raw materials. So again, the range is as an average, it is a bit lower. The gross margins are so I think I mentioned the gross margin range from 40% to 40 to 50% when it comes to the advanced intermediates, as opposed to 30 to 45% in our normal bromine derivative.
This is for the raw material consumption.
Yeah.
So
and again, it depends really from product to product. So, and again, what happens is when this goes down, your processing cost goes higher. So at present, basically, we are saying, okay, at least for FY22, we want to see how the product mix is playing out, which molecules of the advanced intermediates are coming. So let's stabilize this new kind of framework in FY22, and then we'll give a better guidance on, how the gross margin looks like, how EBITDA looks like, for FY23-24, because in FY22 we are already trying to increase the business significantly. Let's say from 336 to 450. We are also trying to stabilize this investment. So there are a lot of variables in this first year. So in first year we are trying to keep the margin similar, so 18% plus or minus 1% in that range. And going forward, as this stabilizes, once we have more idea on the new cost structure,
we can have a better idea on what the margins look like.
But direction-wise, it should be up, right? Because the advanced intermediates are, a much higher pricing versus a bromine derivative. So directionally, is it fair to assume that margin should inch higher?
You can. It's fair to assume it will remain same and may get better. I mean, but basically what happens is, advanced intermediates have its own challenges. So in my opinion, if I look at my margins also, I have basically earned really well where I have done innovation. Now that innovation I could have done in lithium molecule also, in bromine derivative also, and in advanced intermediate also. So where I have done innovation, I earn more margin. When there is not too much innovation, even advanced intermediates and bromine derivative margins can be similar. So, it will really depend upon finally innovation and efficiencies. And we are new to this, right? I mean, the significant increase which we are doing in advanced intermediate, multi-stage chemistry, etc. So give us some time before I can, give you a more confident answer that yes, margins would improve and things like that.
And just what is your current debt?
What is the current debt?
Yeah.
Currently the debt is, Ketan, would you like to answer that? Sorry.
Yeah, the current debt levels are at 216 crores. 216 crores.
This is March end?
216 crores.
Okay.
This is both put together long term and short term. Yeah.
And in that 55 crore of extra, the capex, that capex you'll spend this year, right? The
55 crores.
So that has partly come. Sorry.
Partly come only.
Okay. But the 75 crore is incurred, right?
Yes. 75 is incurred.
Okay. That's right. Okay. Thank you very much. All the best. Thank you, sir.
Thank you. We would request participants to please limit your question to one per participant. And if you have a follow-up question, we would request you to rejoin the queue. Thank you. The next question is from the line of Ashutosh Garud from Ocean Dial AMC. Please go ahead.
Hello.
Yes.
Yeah. So most of the questions have been answered. I wanted to understand what would be the asset turnover over the new capex which we are incurring.
We estimate it to be overall, if you look at overall around 130-140 crore which we are spending in Dahej, is giving us a visibility of around 250 odd crores. So from 500 to from 350 to around 650, so around 300 odd crores. So let's say it's around 2.5 to 3 in that range.
Because since FY17 odd, our asset turnover has been around 3 times, and we have done capex in the past. So is there any is there any possibility that the asset turnover would be exceeding 3 times, given that we are getting into different kind of a chemistry as compared to the bromine, which we used to do, which was the higher revenue share? So don't you think it can give us a better asset turnover going ahead?
So the new molecules require more processing time for a given revenue. So therefore, the asset turns would be either similar or slightly lower. So that's why we are predicting, at least for the existing capex when we did, our view was 650 to 675. Again, it depends on the product mix, but 650 to 675 is a reasonable number. And if you are looking at 650, 675 coming out of around 130, 140 crore revenues, that is translating to around 2.5. Overall, I think, advanced intermediates, because you are also working for MNCs and the standard, because of complex chemistry, the investment also is a little bit on the higher side. And on the other side, the processing time, as I mentioned earlier, is also longer.
Right. So just if you can give us some idea of how the ROE and ROCs would shape up, because we are talking about capex, the asset turnover being slightly lower, and if the margins are going to be similar, then do you think the return ratios would be lower, let's say 3-4 years down the line, as compared to the healthy ones which we have right now?
So I think Ketan has done analysis. I would, let Ketan answer this question.
What we think can estimate is that ROE should improve down the line. And similar at the ROC level for the next this financial year that's ending 22, we might improve slightly, but in the coming years we should improve by at least 2% approximately.
Thank you. I would request Mr. Garu to rejoin the queue for follow-up questions. Request participants to limit your question to one at a time. The next question is from the line of the research team from Canadian Asset Advisors. Please go ahead.
Hi. So my question is more on the capex side. So out of the 135 crore capex, what is the component? So 75 crores is for organic chemicals, right? What is the other breakup of this number?
All of this is for organic.
Okay. So, I mean, our planned capex was 75 crores. Is there a cost overrun, or can you just explain why? Is that over 75 crores?
Yeah, so there were some cost overruns, but I mean, about few crores or something. So we'll have a more clear picture when phase 1 and phase 2 both gets completed. So we'll have an exact idea. But recently you might have seen the steel prices have kind of increased a bit. Also, some of the costs were higher because of COVID-related challenges. Some of the pre-operative expenses also kind of build up, because earlier this was planned to get started in Jan to March. So there is some increase to the tune of around 5 to 10 crores in the range so far. But I think we'll have a proper idea once we finish the year that, okay, what does the overall capex number look like? But I think the increased budget number, debt numbers, which, Ketan shared earlier, they basically take this into account.
Got it. And what part of the 55 crore capex of advanced intermediates is included in current year's capex?
So again, both these are in the same plant, and there is no distinction that this is advanced and this is bromine derivatives. But our estimate is that, so we, just one second. Kiran, do you have that number immediately? So how much of the second phase about 25 crore, yeah. 25 odd crore of the second phase we have done. We still have around 35 crore.
35 crores.
So 35 crores would be something which we will spend next year, right?
Additional capex in Dahej in the current year. I mean, FY22, there would be a 35 crore more capex to get this project completed. Yeah. And there will also be some other maintenance capex at others.
Some guidance on that number, sir?
Currently we have not finalized, but we expect it to be in the range of around 20 to 25.
Thank you. I would request the current participant to rejoin the queue for follow-up questions. The next question is from the line of Bob Lee from Falcon. Please go ahead.
Hi. As we move towards higher scale and higher value-added molecules, which of your peers are you trying to emulate? Are there any players that have achieved, say, turnover about 1,000 crores or so in this business and bromine derivatives?
So thank you for the question. So we have basically three businesses, right? Bromine derivatives, we have the advanced intermediate, and part of that is custom synthesis and manufacturing. And then you have the third, which is a lithium business. So as such, if you were to look at each individual, there are no peers in India which is specialized in bromine, or there are no other peers who are specialized in lithium. But when it comes to advanced intermediate or CSM or similar kind of specialty chemical, if I take a broader view, then there are companies like, Navin Fluorine or SRF, which have some like legacy business like ours. Then they have the specialty intermediates, which have done 1,000 crore plus kind of business. So there is Atul, there is RP, there is Navin, and there is SRF, and there are some others also in CSM space who have done that. So I think, there are some peers like that.
No, but what I mean is specific to bromine.
So specifically to bromine chemistry, there are some 8-9 companies in the world which specialize in making specialty bromine derivatives. So they are in Europe, they are in Japan, some of them are in China, but they've not ventured into the advanced intermediate business. So we are one of the, kind of odd one out when it comes to pure play specialty bromine player who also does more advanced intermediate. So that's why.
So are there bromine players who do bulk bromine?
Yeah. So when it comes to bulk bromine derivatives, that's an entirely different business. And most of the time, there are some few worldwide big bromine manufacturers who themselves make bromine derivatives. So if you were to look at a company called Albemarle, and there was a company called Chemtura, which was acquired by Lanxess. And in Israel, there is a group called ICL, Israel Chemical Limited. So they have a subdivision which is into bromine derivatives. Similarly, Chemtura is now taken over by Lanxess. So they also make bromine and bromine derivatives. And the third is the Albemarle. One of the division is specialized in.
Right. I'm aware of that. I think my question alludes to whether your specialization, your rather narrow specialization in bromine derivatives, allows for a high scale.
Right.
Because there aren't, as far as my research goes, there aren't many companies that are as narrowly focused as you are.
Yeah.
And I don't see companies achieving very high scale. Is this a really niche market where you can't scale up much? I guess is really what I'm after.
Yeah. So, if you were to think of specialty bromine derivatives as a business, what is estimated that the worldwide demand of specialty bromine derivatives per se is about 50,000 metric tons. As against that, we are somewhere already at around 3,000 odd crore of bromine consumption before our expansion, and it may increase to around 4,000 to 5,000 in that range over next 2 to 3 years. So we kind of are at around 10% of what is worldwide specialty bromine consumption range. Of course, what happens is your revenue depends on using that bromine. Do you make a $10 or $15 molecule, or you add more chemistry, make it more complex and make a $200 or a $300 molecule? So that basically says what is the revenue you can get out of that. So that's what we have done, that instead of just limiting ourselves to making only bromine derivatives, we started already now doing bromination plus other chemistries. And, now we've done almost 6-7 stage, multi-stage reaction now for several molecules. And this plant is also designed keeping that in mind. So now it's not only bromine, it's what, how we scale up to this other business. So we already committed, we already kind of envision or plan that the share of this in our business will enhance as we double our business. And then going forward, yes, this is the piece which will keep increasing. And what also happens that once we demonstrate ourselves and our ability to do multi-step chemistry, then sometimes we are already also getting projects where there is no bromination. And still, just because of our reliability, customers come. So while the bromine gets the customer interested to begin with, but once they see the reliability, they also give us other molecules in opportunity.
Thank you. I would request Mr. Lee to rejoin the queue for follow-up questions. The next question is from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Thanks for taking the question. I have 2 questions.
I'm sorry, Mr. Shetty, we cannot hear you.
Yeah. Is it better now?
Your volume is very less, sir. Can you please increase the volume on your phone or come closer to the handset?
Yeah. How about now?
Yeah, Mr. Anirudh, we can hear. So, yeah.
Yeah. So my first question is, if I look at your gross profit margin for the last 2 years, it has been between 39 and 41%, and this is despite your downstream business increasing from practically 0 to now 30%. So given that it's a much higher gross profit margin business compared to the bromine derivatives, why hasn't that reflected in the overall gross profit numbers?
Yeah, so these advanced intermediates have contributed more significantly. So this has been there since almost FY17. So I think you have to start looking from FY15, 16 numbers. But you're right. It's basically in the range of. My range is usually 38 to 42%. So again, even in advanced intermediates, within that, there's multi-step chemistry where there is a bigger differential. So if you are doing one stage, two stage, three stage, it makes a difference. But sometimes what happens is what you are combining also has a higher value. So it depends on that. So that's why when I answered earlier question, just because advanced intermediate, so better gross margins is not always true. So again, within that also it depends on molecules. And there are some molecules where, especially when you are doing 5-stage, 6-stage chemistry, which, we just started doing last year, so that's where you've seen some improvement. And I think that share also of the business is relatively lower. And along with that, a lot of other things are happening in lithium, other bromine derivatives and things like that. So that's why it has been in this narrow range. We've seen some improvement. So we'll see. As I mentioned, give us this 1 year to kind of stabilize, and then we'll have a better idea where the margins go, and, as the percentage of this business also increases.
Got it. And my second question was on the net debt number. So in 2022, are we looking at a 250 to 275 crore net debt number? If you want to confirm that.
Yes.
Okay. So, given that we are looking to do about 450 crores of sales and, assuming EBITDA margin stays at 19%, that's about 85 crores of EBITDA. So, we'll be closer towards the 3 times kind of net debt to EBITDA. So, just wanted your thoughts on, how do you look at, balancing growth and, the balance sheet strength, and if there's any red line that you guys think of internally beyond which you would not like to go.
Yeah, so I think we've mentioned that ideally, like debt equity, not more than 1.25, and debt EBITDA, not more than 3.5. I mean, these two are kind of, this is what we don't want to do, and, that's when we think we will take a pause. Of course, now what has happened is that, in this year we are doing 450, but majority of investment for, reaching up to 650 will happen now. So that's why this is a year, and then, next year we will again take a call whether we need to do that or we need to take a pause, or even if we do, maybe we'll do it in second half, because we have enough headroom for FY23, and only once we know what is FY23 clarity of how much we are reaching, and only when we feel that the capacity is now hitting 80% utilization on a regular basis, that's when we'll think of a significant capex. I mean, we'll do maintenance capex. We may do some small incremental capex for some specific molecules for modification or things like that. But this is what our current comfort levels are. So we are okay, when we know for some quarters or for a year we are exceeding this slightly, we are okay, but not for a long period of time.
Thank you. The next question is from the line of Dhavan Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So most of my questions have been answered. So I have just 1-2 questions. Firstly, about the customer engagement for the CSM business. So you said that maybe the additional 2 to 4 customers that we were engaging maybe 2 or 3 quarters back. So how is the, is there any stopping block over there? I mean, because of the COVID-related challenges, the negotiation has not been improved, or is there any other, challenges you are facing? So if you can share thoughts on that, and maybe, if we get 1 or 2 customers, maybe new additional customer for the CSM business, do we have to come up with the further capex? I mean, this phase 2, maybe doing some bit for the organic growth, but if another 2 customers comes in, then do we have to go ahead with the another expansion? If you can share thoughts on that.
So I think on the first, basically what is happening is that when we said 2 quarters, at the end of quarter 2, when we had planned our this additional capex, is when we had mentioned that number. So roughly around 2 quarters ago, we had that discussion, and generally there is no challenges with regards to COVID. It's only that it's going through the stages. So there's a developmental cycle, as I mentioned, where you first make it few kgs in R&D, then you make few hundreds of kgs in pilot plant, then you make a first commercial run of 1 ton, 2 ton, or couple of metric tons, and then you go get into the tens of metric ton or hundreds of metric ton, depending on how many stages and value of the material. So I think
we are just going through that phases, and it's going from one stage to another, and that is something which is expected. But so some of these are the ones which would be required in the second half of FY23 or early FY24. They would most likely materialize. And again, if they don't for any reason, we also have existing demand from our existing customers which will be required. So I think that's answering your first question. The second question is that yes, as long as if the revenues are remaining in this phase up to 650 crore, as long what our estimate is that the existing capacity should be sufficient. I mean, we may have to doing some rejig here or there or change few reactors, etc. But we don't require a major capex where we have to build a new manufacturing block. If the revenue potential goes beyond 650, that is when we will have to set up another manufacturing block either in Dahej or in Karakli, for which we have environment clearance, and now we have major infrastructure. So relatively, it can come up with a shorter duration of time. So we'll think of that only once we have a very clear visibility on the 650, 675, and that's when we'll take a call.
And sir, how is the order backlog for this, the two customers which we have got maybe 2 quarters back? So how is the order book in the CSM business? I mean, how much revenue are we expecting for this first year?
Yeah, so I had guided that we are expecting around 60 to 80 crore between the two customers in this year. And, more or less based on whatever POs we have already received, or, some of the one customer releases PO every quarter on quarter. But, they give us a volume projection. So based on that, we are in that range that these two contracts together should contribute around 60 to 80 crore in the current financial year.
Okay. And so lastly, about the other expenditure, you mentioned that there was some higher manufacturing costs, but still, if I look at on quarter basis, I mean, around 3 to 4 crore is still higher. So is this entirely related to the manufacturing cost, or is there any one-time cost also?
No, this is entirely manufacturing cost. One is, the utilization levels in this quarter was a bit higher because, previous quarters there was always something or other related to COVID. But in Q4, we hit almost close to 90% utilization levels in organic at both my plants, where, normal norm is around 80%. So that was one of the contributing factors. And the second was, as I said, that we had a set of products where, the processing time was more, so, and the raw material cost was lower, so that the RM percentage was lower and the manufacturing cost was higher. So there is no specific one time for this.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to the management for closing comments.
Thank you all the participants for joining the call. I hope we were able to satisfactorily respond to your questions. If you have any more questions, please feel free to contact our investor relation team, CDR India, and we will address them. Thank you once again, and we look forward to connecting with all of you in the next quarter.
Thank you. On behalf of Neogen Chemicals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.